Hi, my name is Danielle Glosson, and I'm in the Masters of Entrepreneurship program at Western Carolina University. Today I will review financial ratios and explain where they come from, when they're used, and what they tell us about a business. Financial ratios consist of solvency, efficiency, and profitability ratios. A solvency ratio measures a company's ability to meet long-term debt. The ratio provides an assessment of the probability a company can continue meeting the debt obligations. A solvency ratio higher than 20% reflects a pretty financially sound business. The 6 key financial ratios used to measure solvency include current ratio, quick ratio, current debts of inventory, current debts to net worth ratio, total liabilities to net worth ratio, and fixed assets to net worth ratio. As you can see, I've listed the formulas on how to acquire each of these ratios. The current ratio quantifies short-term solvency and helps compare assets to liabilities. The quick ratio, also known as liquid ratios, reveals a company's reliability on inventory and other forms of short-term debts. Current debts to inventory is computed to see the ability to repay those debts. Current debts to net worth indicate the percentage of shareholders' investment. Total liabilities to net worth shows the relationship between the total debts and owner's equity of a company. A higher ratio means less protection for business creditors. So finally, the fixed assets to net worth represents the fixed asset percentage compared to the total equity. Efficiency ratios measures the ability to utilize assets effectively as well as the management of the liabilities. The inventory turnover indicates a company's inventory level management. Too low suggests overstocking or selling issues. Therefore, a higher inventory turnover is ideal. The accounts receivable turnover, this highlights the company's credit policies. A low turnover may mean the company is being too generous granting credit, or it isn't collecting from the customers. Accounts payable turnover measures how a company pays its own bills. You want a low turnover because the high turnover indicates lack of favorable payments terms from your suppliers. Last is the total asset turnover. This shows the effectiveness of both short-term and long-term assets. The company strives for a high turnover to show positive success. Next is the profitability ratio. This ratio measures the ability to control expenses and earn returns on resources that are devoted to the business. It's the ability to make a profit and measures the company's performance. Net profit margin measures the amount of money made on every dollar of sales. This covers operating costs, including your direct cost. Operating margin subtracts unrelated expenses to direct production like overhead and administrative expenses. The gross profit margin is the profit earned on products without indirect cost. The return on assets measures the ability to create profit through its assets. Return on investment measures the income earned on invested capital, whereas the return on equity measures how much is made on each of the investor's dollars. And last, the last profitability ratio is the return on sales. This measures the net income dollars generated by each dollar of sales. So where does the data come from? All of the formulas for each of the financial ratios come from the financial statements, which include the balance sheet, the income statement, and the sources and uses of cash. The financial ratios are important because a company can compare short-term and long-term data against themselves. This will reveal the strengths and weaknesses throughout the business. A company can also compare their data to the direct competition. So success is measured by the control of the market, and a company will only know for sure when they compare the numbers to other businesses. Last, the company can use the financial ratios for comparison to the industry. Control of the industry includes across the country and internationally. I feel like international control of the industry is a business' ultimate goal. So, can financial ratios affect a business in their decision making? I wanted to highlight each ratio. So, the solvency ratio, that's all your debt. You want a ratio that is 20% or higher. This actually is going to be determined from your lenders if they want to further any loans. They're going to analyze your solvency ratio. A low solvency ratio can potentially indicate that you're going to go bankrupt because you can't pay the debt. So maybe some decision making that a company might have is to maybe increase your price of goods to get more money generated. The founders, maybe even the CEO, you're going to receive little to no salary just to make sure that you can pay that debt before you start paying yourselves. And you could also maybe decide to invest in a marketing campaign, even though that would add some extra dollars to support that. Maybe you can get more sales, which will mean more money. The efficiency is your short-term debt. This is where a company wants to squeeze every dollar they can from the operations. The idea here is to cut your expenses and increase your revenue. For banks, especially, they want a low percentage, around 50%. So for every 50 cents, it's worth to them to spend is worth $1. So they're getting more money in there. So maybe you can, a decision would be buying in bulk. So you'll buy larger amounts of supplies or goods, hopefully at a cheaper rate. So that way you're cutting some expenses there, and then increase your product line. Use products that you've already purchased, and make sure that you're using them in a proper way to make other products to increase your revenue, but using every dollar from your operations. The profitability ratio, they talk about a 10 to 14% return on investment is what you want to have to be able to fund future growth of the business, those additional rounds. A low ratio can indicate poor management. Maybe the business has a conservative approach. So some of the decision making is to really look internally and look at your management team. You might have to do something that's tough for you, and that's fire management. Just kind of go a different direction, or change your business approach if it's not aggressive enough. Really research and look into that and make some changes to support your profitability. Thank you guys for listening to my screencast. I hope you learned some things on financial ratios. Right here is listed all the references that I used in case if y'all wanted to go back and research some of these things. But thank you again.